for October 2015. Let's quickly go around the room, introduce ourselves for the record.
Good morning, Rosemary DeBellis, designee for Police Commissioner Broughton.
I'm sorry, who was that?
Oh, Rosemary
Oh, I'm sorry. okay.
DeBellis, designee for Police Commissioner Broughton.
Barry Dennis, SIS, consultant to the fund.
Dan Torelli, with the proxy for Pat Lynch, John Puglisi, and Mubarak Abdul-Jabbar, PBA.
Joe Rayo, PBA.
Chris McGrath, PBA by invitation.
Gary DeRosa, SBA, designee Ed Mullins.
Lou Turco, LBA.
Roy Richter, CEA.
Bill McNeely, DEA, designee Mike Palladino.
Comptroller's Office by invitation.
Enosh Kachela, Controller's Office by invitation.
Alex Donier, Comptroller's Office by invitation.
Robert Fang, Controller's Office by invitation.
Sherry Chan, New York City Chief Actuary, present by invitation.
John Mercerberg, Controller's Office by invitation.
Scott Evans, Controller's Office by invitation.
John Dorset, designee for Comptroller Stringer.
John Adler, designee for Mayor Bill de Blasio.
Antonio Rodriguez, designee for Finance Commissioner Jihad.
Bob Sanskisted, Pension Fund by invitation.
Kevin Holleran, Pension Fund by invitation.
Comptroller's Office by invitation.
Neil Messing, Controller's Office by invitation. Two more.
Nicole Chambrisi, Police Pension Fund, present by invitation.
Christopher Miner, Police Pension Fund, present by invitation.
Okay, thank you, and I'll turn it over to Scott.
Thanks very much, and Scott Evans. So today we're going to be in the flip book, looking at the monthly results for August. We'll start on page 27, and we'll look at them quickly. They were painful. It was a down month for the markets. If you look at the top panel, which has the U.S. markets, they were down 6%, depending on which part of the market you're looking at. International markets, the developed portion, IFI, was down 7%, and the emerging markets were down 9%, with the overall world index down 6.5%. You saw some weakness, but much more muted in bonds, particularly in the high yield bond area. If you turn to page 37, you can see the impact on the portfolio. And despite the fact that the equity markets were down 6%, the overall portfolio was down 3.24%. The benefit of running in a diversified portfolio. Our benchmark was down 348, so we actually picked up 24 basis points on the benchmark. So on a relative basis, it was, pretty straightforward month. On an absolute basis, there was a lot of rock and roll out there in the markets. You can see that clearly, and I mentioned this last time, so I'll be brief, on page 18. It's just a good indicator of the anxiety in the market. This is the S&P Volatility Index, known as the VIX, and it gives a sense of how much people are uncomfortable, what the implied volatility is in the options markets. You can see that they haven't been this uncomfortable since 2011. What drove the discomfort was China, and the fact that China was going through a series of what appeared to be fairly desperate attempts to save their equity markets, turn them around, inject funds into them. Their markets are small. They seem to be speculative. The initial reaction was a shrug of the shoulders to this kind of speculative activity. But as China took more and more severe measures, people became concerned. And then when they let their currency drop suddenly 3% in one day, the volatility spiked. And China has been, since then, trying to calm people down, that they have a measured pace and a plan to deal with the slower growth that they're experiencing as they move from an export-based economy to focus more on consumption. China's critical. That anxiety is not going to go away. So I think higher volatility is with us. We're built to deal with volatility. We still need to take risk, and one of the positive aspects is that we're getting paid more to take risk in the market. You can see that by looking at high yield spreads on page 21 in red. You can see that you're getting paid more to buy riskier bonds, and you can see right below that the PE line, which is in blue, the price that you're paying for a dollar of earnings has gone down considerably, so that we're now approaching the mid-teens, a level we haven't seen in a while. So I think this is decent news, but we are in a period of volatility. The markets are going to be jumpy. They were very jumpy last Friday when the employment numbers came in a little weaker than people thought. And then when it became apparent that the Federal Reserve might wait another month before raising interest rates, the market spiked up. We have a kind of steady as she goes approach to this volatility. We're not trying to surf the opportunities, although some of our managers are pretty active out there. If you look at page 30, you can see our position relative to the asset classes. On the left side, equities, we try to keep pretty close to zero, or the target asset allocation. You can see that several of the asset classes, domestic and developed equities, and particularly emerging markets, slipped out a little bit because they went down so much relative to the rest of the market. Our policy is to rebalance. We've done some of that over the last few weeks. We'll do some more as we go forward, keeping us on course for the overall asset allocation that you all have specified. We'll talk later about the fact that we're working with Barry and SIS on the long-term asset allocation in light of the expectations for the market. Fixed income, I won't go through again, other than to say when you put the gray and the blue, the short-term and long-term bonds together, we have about a typical interest rate exposure similar to the Barclays Aggregate Index.
Scott, can I ask you a question?
Yeah.
I'm looking at page 49 with the hedge funds. Now, that's where I know there's a lot of discussion on fees in the down market is when you're looking for the hedge funds to sort of pull your pants up a little bit. And how accurate are these numbers? Are these net of fees?
Correct.
Or are these gross? These are net.
Yeah, these would be net of fees in the hedge fund space.
And are they able to give us a pretty accurate accounting given their investments? And generally, I found them, with the J curve and sort of a little concerned as to what it's actually worth.
Yeah, you experience that in the private equity markets where they're investing the capital at the beginning, and you're paying fees on committed capital, even though you haven't invested the full capital, and so your net returns are going to be lower because you have the burden of the invested capital. In hedge funds, you generally invest all the money right up front, and you just pay on invested capital, so you don't run into that same J-curve effect. You're going to have the results immediately. With the hedge funds, they will have both long exposures and short exposures, so you don't have a full exposure to the market. We end up being about 20-30% exposed to the market with our hedge fund policy. And so you're not going to have the same sensitivity to the markets that you'll have in the public equities or even in the private equities. Private equities comes with a lag. But we get monthly snapshots of the hedge fund portfolio, and this would have been accurate as of the end of August. Neil, do you want to add any comments to that?
Sure. Yeah, so our beta our beta to the market has been somewhere between 20 and 30, right? So when the market's down 6% in the month, the return that you see here for August makes sense given what our beta has been so far.
So we beat our benchmark by about 24 basis points. Is it attributable to our hedge fund investments?
Some of it, yes.
Or is it a high yield?
Well, if you look here, you can see that the hedge funds beat the benchmark for the month by 32 basis points. then you have to multiply that 32 basis points by the percentage in the portfolio. So it would account for a portion of the outperformance. As you look down, Roy, in the other asset classes, you can see different results. The fund of funds, hedge funds, had a good month relative to the benchmark, then outperformed by 176 basis points, but it's only $153 million. You see a lot of green as you look down here, so a lot of the various asset classes are performing well relative to their benchmarks. You have a few that aren't, but that's how you would look at it, and you would expect hedge funds to pick up a little bit, certainly on an absolute basis. But this basis points is measuring how we did relative to the hedge fund index, and since the portfolio that we have, as Neil said, 20 to 30% beta, tends to be less exposure to the market than the benchmark has, the fund of funds index. This is as we'd expect it to be. Any other questions? If not, we'll turn. We have an outside speaker today, part of our educational trustee education session from Goldman Sachs. And why don't we bring them in? I'll let. Thanks for joining us, guys. If you could just give your names to the Linda. I'm sorry, Linda. She'll transcribe that into the record, and then we can keep going.
I'm Lisa Rotenberg, Rotenberg.
And Matt, Matt Weir, W-E-I-R.
Good morning. We'd like to thank the Comptroller's Office in the New York City Police Board for inviting us to present Goldman Sachs Asset Management's macro views today. Just a few points. One, Goldman Sachs Asset Management is the fiduciary side of Goldman Sachs, just for your information. This is this has been a period of market volatility and uncertainty, so we think this is a particularly good time to share some of our views, especially with news coming out of China and Europe. We don't think these risks are going to pose any significant risks in terms of derailing growth in the United States, and we think that the United States remains the world's preeminent economy. Before turning over to Matt, just wanted to introduce ourselves. I'm Lisa Rotenberg. I'm a managing director at Goldman Sachs. I've been at Goldman Sachs for 21 years. And Matt Weir is managing director. He is a senior member of our investment strategy group, and he focuses on both strategic and tactical asset allocation and identifying investment opportunities in global markets. Matt?
Perfect. Thank you very much, Lisa. Thank you also for having us here. We're honored to be here. As Lisa mentioned, when we look across the global economy, the key question we think that investors need to answer is, what is the outlook for the U.S. economy? And the reason we answer that way is because despite other global economies having grown very quickly in the last couple of decades, we still think that the number one source of demand for the global economy is coming from the U.S. So what happens here really matters to all economies and financial markets. Today, we wanted to walk through some of the reasons we get to that conclusion and provide some of the bigger picture investment conclusions that we provide our clients. When we look across the global economy, we do look at each of the major economies. We look at a variety of factors. On page 2 in the presentation we passed out, we list 3 of those factors. We look at economic fundamentals for countries. We look at financial indicators and also human capital. These are the factors when we look across for the U.S. and other countries that make the U.S. stand out as being preeminent. So we'll review each of these in turn and then wrap up with some of our key conclusions and also risks to global markets. Turning to slide 3, we'll start with economic preeminence. Here we're looking at how the growth in the U.S. GDP compares to that of the other major developed economies since the financial crisis. On the left-hand side of the page, we note that when you compare how U.S. GDP has grown versus GDP in the Eurozone and in Japan, the U.S. has outgrown those two economies considerably. On a cumulative basis, U.S. GDP, which is the measure of entire activity for the economy, has grown by 13%, much faster than Japan, and significantly faster than the Eurozone. So on this basis, we see that the U.S. economy is preeminent. Additionally, when we look across these three economies, we note that the U.S., believe it or not, is the only economy that is larger today than it was prior to the financial crisis. So during the financial crisis, each of these economies contracted in size. The U.S. has not just made it back to its prior peak, but it's 8.5% larger than it was at its peak prior to the crisis. In contrast, the Eurozone and Japan, those economies actually remain below their 2007 peak level. Let's also talk about the emerging markets, which we have some exhibits for on page 4. As I mentioned, it is the case that over the last several decades, emerging markets economies have been growing faster than that of the U.S. But looking forward, we note that the U.S. economy is unlikely to grow at such a lower magnitude than emerging markets than we've seen over the last couple of decades. On the left-hand side of the page, you can see the gap between growth in the U.S. economy and emerging markets. In 2007, the gap was 6.5%, meaning emerging markets growth rate was 6.5 percentage points higher than that of the U.S. What we've seen since then, however, is actually that gap narrow. So the U.S. economy is gaining relative strength versus emerging markets. We think this is a very, very important development and something investors should be taking into account going forward. We'd also note that when we look at emerging markets from an investment perspective, we encourage investors to always understand exactly what they're investing in. Emerging markets, by definition, are poor economies. When we compare the wealth of the U.S. and other developed markets versus the emerging markets, we note that there's a very big discrepancy. Ideally, emerging markets will continue to develop and we won't see this discrepancy persist into the future, but we would note that despite emerging markets growing faster than the U.S., when you look at the amount of output for the U.S. economy per capita, so per each person in the United States, that number currently is about $55,000. So output of $55,000 per person in the U.S. Comparing that to China, China's GDP per capita is well less than that. It's lower than $8,000 per person. That illustrates the significant difference in the underlying wealth of these economies, despite the fast growth in emerging markets. We would also note that despite the fast growth in emerging markets, that gap has actually widened in recent years. So in 2007, prior to the financial crisis, the gap in GDP per capita was about $45,000 between the U.S. and China. Today, that gap is $48,000. This, we think, speaks to the underlying strength of the U.S. economy. Now, where do we stand from a growth perspective? Clearly, we are about 6 years into the recovery since the global financial crisis ended in 2009. The emerging markets have grown faster than the U.S. and other developed markets. But when we look to the future, we see developed markets, including the U.S., growing at a faster rate than it has over the last few years, and emerging markets slowing down. So as we look to this year and compare it to where growth was globally last, we see global growth growing at a similar rate of about 3%. That's despite slowing growth in emerging markets because we've seen faster growth in developed markets, including the US, the Eurozone, and Japan. Outside of the economic factors, we also see financial preeminence in the US versus other markets. On slide 6, we're looking at earnings for the US corporate economy, comparing to earnings of other economies. We note that earnings in the US have grown significantly from their trough level, their low point in 2009. Yes, it is the case that emerging markets have grown their earnings faster than the US since then. We would note, however, that growth outperformance has been entirely due to China, and specifically China's banking sector. I highlight that because when we look at the risks to the global economy, we think that the number one risk facing the world's economy is China and its banking sector. Essentially, China has repeated some of the mistakes that the US made prior to our financial crisis by increasing the amount of debt in its economy faster than its underlying growth rate. Finally, in terms of the factors we look at in assessing the outlook for the global economy and why we think that the US is better positioned than other markets, is on human capital. This relates to innovation, education, as well as, and this is timely, Nobel Prizes are being awarded over the next several days. The US economy and the US citizenry have continually won the highest proportion of Nobel Prizes. We think this is something that pertains and is important from an economic standpoint because a major contributor to GDP growth is how quickly is this economy growing its productivity and innovating. When we look across a variety of factors, we see that the US economy stands out. The first way we measure this on the left-hand side of page 7 is simply how much output is there in the economy per worker. This is akin to the GDP per capita measure we looked at earlier. You can see when we look at this measure, the US workforce is much more productive than all of the other developed markets as well as all of the other emerging markets. This gives the US economy a significant leg up compared to others. Additionally, we've seen US workers become even more productive at a faster rate than other economies, which is what we're showing on the right-hand side of page 7. The amount that each US worker is producing has grown by 1.1% per year since 2004. That's nearly double the rate of productivity growth that we've seen in other developed economies like Japan, the UK, and the Eurozone. And finally, with regards to human capital, this is something surprising, but I know we are all aware that the Chinese economy has grown significantly over the last couple of decades because they've benefited from globalization. They've benefited from being able to participate more in global trading markets. As a consequence, we've seen a lot of US corporations move production outside of the US and into lower cost places to produce like China. But something interesting has been happening over the last decade, and that is as demand for Chinese labor has increased, so has the wage growth for Chinese workers. That increases the cost to US corporations to produce overseas. Additionally, you've seen energy costs, which is probably the most important or the largest cost for US companies. We've seen energy costs for US companies decline thanks to increased production of oil and natural gas in the US economy. US corporations pay less for energy if they produce in the US than if they're producing outside of the US because you have not seen energy costs fall to the degree that they have in the US. The point in sharing all of this is that as US corporations now are deciding where to produce their goods and services, the US producing domestically is becoming increasingly attractive. We think this is another favorable undercurrent for the US economy and a reason why we, and in conclusion with regards to the US outlook, recommend that our investors, we advise them to invest the corpus of their portfolios, so the majority of their assets, in US-based investments. In preparing for today's meeting, it was interesting to note that in looking at the asset allocation of your portfolio, the share of assets dedicated to investing in U.S. equities is very similar to what we advise for our clients. So within the public equity realm, you have about 2/3 of your assets invested in U.S. equities, 1/3 outside of the U.S. That's roughly similar to what we advise our clients. And what we advise is entirely based on all the factors that we've discussed so far. After that conclusion, we also do want to spend a little bit of time looking at where we are in the financial markets, briefly on equities, fixed income, and then we'll conclude our remarks. First, with regards to U.S. equities, we now are beyond the 5-year mark of the current equity bull market. The S&P 500 hit its low level in March 2009. So we're about 5.5 years into this bull market. A key question, therefore, well, how much longer can this bull market last, and should investors start to be nervous? We would note a couple of things. We have found historically, when you look at prior bull markets in the U.S., bull markets don't necessarily die just of old age. In fact, we have seen other bull markets last longer, and in some cases considerably longer, than the current bull market. And additionally, we've seen other bull markets reach even higher returns than we already seen in this cycle. Here we're showing 5 bull markets since World War II. The current bull market is the red line on page 9, and you can see that only 2 bull markets have lasted longer, but in one case it's lasted significantly longer, and we show these numbers on the table on the right-hand side. The bull market that began in October 1990, if we use that as the roadmap for the current bull market, we still have about 3 years remaining and quite a bit of upside. That bull market, if we were to exactly follow its playbook, we would have an additional 97% of return to U.S. equities before this bull market would end. So far, we have seen a return for U.S. equities of over 200%, so a further 97% would clearly represent a very large return from here. There are 2 other bull markets that have reached a higher return than we've seen so far. Those were 1949 and 1982. In each of those, you saw further upside. In the case of 1982, of 24%. In the case of 1949, at 79%. So we conclude that based on where we see the U.S. economy standing and where we've seen prior bull markets end, we don't think we're at the end of this bull market for the U.S. That's not to say, though, we won't see volatility. On slide 10, this is a fairly technical slide, but I think it can be summarized very clearly, is even if you are in a bull market, that does not mean that you are going to have smooth sailing and avoid declines in the market price of 10% or more. In fact, what we've seen over the last few years of relatively smooth sailing has been unusual. Typically, you see a price decline in U.S. equities of greater than 10% every 2 years. Well, we just saw a 12% peak to trough decline in the U.S. equity market in August. That was the first decline of more than 10% we had seen in 4 years. So in other words, we're fairly overdue for a decline. Now, a 10% decline does not end a bull market. Equities, as you are aware, are among the most volatile of asset classes. The typical annualized volatility for U.S. equities is 15%. A 10% decline doesn't necessarily mean you've ended a bull market. Typically, you need to see a decline well north of 20% to end a bull market. Moving away from equities and the other asset class I'll discuss before reaching our conclusions is interest rates. One of the messages we frequently hear from market commentators and fund managers is that interest rates today are artificially low and there's only one direction for them to head, and that's up. Well, we want to provide some historical context for interest rates because we think it's important to note that it's not necessarily unprecedented for low interest rates to persist. On the left-hand side of page 11, we show the 10-year Treasury yield going all the way back to 1790. I am not able to tell you exactly how someone was able to collect data going back to 1790 on interest rates. There are database providers who do that for us. But what we see when we look at the historical record is that we do go through multi-year periods where interest rates stay below long-term average levels for a fairly long period of time. Today, when I left the office this morning, the U.S. 10-year yield was right about 2%, 2.04%. The historical average 10-year Treasury yield has been 4.8%. So we are sitting at a very low interest rate level. The 10-year Treasury yield has been below 3% for the bulk of the time over the last 4 years, 98% of the time over the last 3.7 years, to be very, very precise. When we look historically, we would note that this period of low interest rates may very well continue for a long period of time. Following World War II and the Great Depression, we note that interest rates in the U.S. stayed below 3% for 21 years. They stayed below 2.5% for 11.5 years. If we look outside of the U.S., Japan has had a 10-year yield below 2.5% for the last 18 years. So when we hear commentators say interest rates are low, so therefore there's only one direction for interest rates to go, we just want to provide some historical context. It could be the case that rates do rise from here, but we want to set expectations reasonably based on the historical context. I should say that the Fed does appear as though it will be raising rates in the next 6 months, but we do think that if they do begin raising rates, they will only do so at a very slow rate. So why don't we conclude?
So 6 months means like in 2016?
So we would say the most likely time for them to raise interest rates is December, but the March meeting is looking almost as likely given the weak data we got at the end of last week. So while it seems December is more likely than March, the probability on March is increasing.
It seems that for the last 2 years, it's been the same commentary.
Waiting for Godot, yes. Now, what we will say is we think we are closer now than we've ever been. And the reason I say that is the Fed has two mandates. It's maximum employment and price stability. They define price stability as inflation of 2%. We are not near 2%. We haven't reached that. But on maximum employment, you could argue that we've started to reach levels consistent with maximum employment. We haven't been this close to maximum employment so far in this recovery. That's why we think we're closer to the first rate hike. But the uncertainty emanating from China does raise the risk that the first rate hike won't come this year. Now, Fed commentary though, Janet Yellen is on the record, John Williams from San Francisco is on the record, Bill Dudley is on the record from just the last couple of weeks saying their base case is they'll be raising rates this year.
But are they on the record because they feel they made a mistake in the last meeting? They're not raising rates?
Well, what's interesting is, so we've seen an evolution in how the market has responded to the Fed's decision in September. Initially, the market sold off, thinking that the Fed made a mistake by not raising rates. But what's interesting is Friday, especially yesterday, and then this morning, as of 30 minutes ago, who knows what's happened since then, markets are still rallying. And I'm wondering if that's because markets see what the Fed decided in September as not being a mistake. Maybe initially the markets thought, okay, the Fed made a mistake, they're staying too easy. But after the disappointing employment report Friday, the ISM, which is an important leading indicator for the U.S. economy, was reported Thursday, and that disappointed. It was lower than expected. I think the markets perversely are actually rallying over the last few days because the risk of the Fed having made a mistake may be lower since growth does seem to be coming in slower than expected.
Because what was the yield on a 3-month? Like 0, I think.
Yeah, the 3-month debuted at a negative interest rate yesterday. So markets have priced out the probability of the Fed raising interest rates, I think, entirely out of October. The Fed meets this month, but it seems unlikely they'll be raising rates in October. So when I conclude, I'm cognizant of the time. On page 12, we are advising our clients that the bull market is not over, that the U.S. recovery will continue. So we advise clients to remain invested in their long-term allocations to U.S. equities. While we do think interest rates will rise, we think any increase will be slow and that rates will remain at historically low levels. I've highlighted some of the risks that we're watching, one being China, 2, a policy mistake, or heightened financial market volatility around the Federal Reserve raising interest rates. But there are clearly other risks that we're watching. Europe, rising risk of elections in Europe that could bring in governments that won't pass much needed reforms. Additionally, geopolitical crises, especially Russia, Ukraine, increasingly what's happening in Syria and ISIS, but additionally other areas like North Korea, Iraq also pose very hard, I would say impossible risks to forecast, but risks that we should all at least keep some focus on because they could always ignite a downturn in financial markets. So with that, why don't I wrap up at least the prepared comments and ask if there are any other questions.
Any other questions? You mentioned that you all are recommending 2/3 exposure to U.S. equities. How has that changed over time? You look over the past 5 years. Have you brought it down? Is it about where it's been?
So in 2012, we actually recommended increasing some exposure to emerging markets. And very famous quote, I think it was Keynes who said, when the facts change, what do you do, sir? Do you change your mind? Well, we did some initial analysis on emerging markets such that by 2013 we actually cut back on some of the addition to emerging markets that we had recommended in 2012.
Did the source of funds come from U.S. or did it come from
a mix
Europe?
of U.S. and some Europe and Japan.
Okay, so you just recently reduced emerging markets and put it back in the U.S.
Correct. And when we compare the allocation that we advise clients to have to emerging markets to others, we are underweight emerging market exposure. So if you were to look at the market cap of emerging markets and compare that to the share of assets we recommend, we're actually below what the market cap would suggest.
And how do you do? You made a good case for the strong economic base that we have in the U.S.
Yeah.
But when you look at the large companies that dominate the U.S. market,
yes,
they have quite a bit of exposure overseas to Europe as well as to the emerging markets.
Certainly.
And that exposure has risen quite considerably over the period of time that you've studied here.
Yes.
How do you judge that? And aren't these risk scenarios that you paint also risky for the earnings trajectory of U.S. companies?
Yeah, absolutely. That's a very good point because coming out of the crisis, the growth in this current recovery for the U.S. has been slower than normal. So, not surprisingly, if you're a corporate manager, you see faster growth overseas. Well, especially if you're producing anything there, why not try to sell there as well? So we've seen an increasing amount of S&P 500, which is the largest companies in the U.S., selling overseas. Companies aren't obliged to disclose exactly what % of their sales go overseas, but a number of our colleagues have tried to estimate. We've been surprised, actually, that the amount of overseas sales exposure isn't as large as what we thought it was, and certainly not to emerging markets. We've seen especially high sales exposure to other developed markets, but emerging market sales exposure, I believe, and we'll come back to you with the actual number, is 5% or less. So You're absolutely correct. If growth is slowing overseas, especially if there are risks of what some economists call a hard landing in China, the U.S. economy will by no means be immune to that. You're going to see probably spillover in three channels. Trade with China is going to decline. You're going to see a knock-on effects to other economies that are more exposed to China than the U.S. So to the extent we're trading with Germany, well, Germany is very exposed to China. So if China slows, Germany slows. Well, that will also affect our economy. And then lastly, and you will all be very familiar with this, that if you were to look at the amount of exposure pension funds broadly had to emerging markets, say in the 1990s versus what they are today, well, they're much higher today. So if you have turbulence in emerging markets, US-based investors will have financial market exposure as well. It's very, very difficult to estimate exactly how much the impact or that drag will be on the US economy. The estimates that we have come to ourselves, as well as we work with economists outside of Goldman Sachs, we estimate that for every 1% drag, or for every 1% deceleration in China growth, so not a 1% decline in the economy, but if Chinese growth slowed from, say, 6.5% to 5.5%, that would hurt US GDP growth by about 0.2%, 0.2. So if the US economy is expected to grow at 2.5%, that would knock growth down to 2.3%. That is an estimate. Economists always want to put a range around that. There's a range of uncertainty, certainly, around that, but that's our best estimate.
Thanks. Other questions?
Yeah. You mentioned that you feel like U.S. unemployment has just about reached its limit. And yet, correct me if I'm wrong, we still haven't seen any real wage growth.
Yes, correct.
Wouldn't a better measure of when we've reached, quote unquote, full employment be when we start to see some wage growth?
Correct.
That would also help be an economic driver?
Yes, absolutely. It is unusual that we have seen this rate of GDP growth, this amount of decline in the unemployment rate, without seeing more wage growth than we've seen. And that's a big question mark for the Fed. There are very prominent economists, Larry Summers, Paul Krugman, who say, well, the Fed should wait exactly for this reason, that you shouldn't raise interest rates, perhaps hurt GDP growth before you've seen really much wage growth to speak of. Now, we don't know exactly, but if Janet Yellen, Bill Dudley, Stan Fisher, which are the three senior most people at the Fed, believe that wage growth is around the corner, and the risks to waiting to raise rates until you see wage growth is that inflation rises uncontrollably, then they could raise rates earlier. So it seems as though the Fed's reaction function is perhaps we don't need to wait for wage growth to raise interest rates because we have enough confidence wage growth is coming, and the risks to waiting are that we've waited too long by the time wage growth comes around.
Waited too long because it would result in inflation?
Yeah, they would think that as the labor market tightens, companies will need to pay more to hire workers. As a consequence of earning more money, workers will then spend more money, and that pushes upward demand. That's demand-driven inflation. That is, I think, the best guess at how the Fed is thinking about it, that it's just a matter of time before you see that chain of events occur. Now, interestingly, Ben Bernanke, after he left the Fed and joined the Brookings Institute, has written a couple of years ago that he did not think the Fed would raise interest rates until they saw more wage growth than what we've seen so far. Last week, he said that he has changed his mind. He actually thinks the Fed will raise interest rates ahead of wage growth accelerating, because the underlying rate of improvement in the unemployment rate and underlying GDP growth, the momentum is strong enough to justify raising rates. It is a risk. The Fed could raise rates too soon, and that is a downside scenario. That's one of the risks in terms of what we say a disorderly Federal Reserve tightening, meaning a policy mistake where they raise rates, growth slows, and all of a sudden we're talking about risk of deflation as opposed to inflation.
You don't think the price of oil and gasoline has a big impact on?
Yeah, so it absolutely has an impact on inflation. Now, what's been interesting is we've thought that the decline in the oil price and gasoline prices should have been a good stimulus to the economy. That for so many households, because energy spend is one of the largest items in their budget, if you see a cut to that, you could see spending elsewhere. And that could bring around perhaps some of the demand-driven inflation for non-energy goods and services. What's been interesting, though, is you haven't necessarily seen consumers respond to the decline in the oil and gas price that we've historically seen, and it's one of the mysteries. Perhaps the global financial crisis is still recent enough memory that we are just more conservative spenders than we've been historically, perhaps for good reason, because it was such a traumatic and deep recession.
Okay, thanks very much.
Just wanted to thank you again for inviting us, and also wanted to say we appreciate the confidence that the New York City Police Fund has in our Goldman Sachs Asset Management Fixed Income team. We've been working with you since 2009. Look forward to more years ahead.
Thanks very much, Susan.
Thank you.
Okay, Madam Chair, that concludes our formal comments for the public session.
Okay, do we have a motion to exit the public session?
So moved.
Second.
Wow, that was quick.
Like, can we third?
Need a motion to go into executive session?
Motion.
Motion, second, BBA.